Some people find trading stressful, but not me. Hi, I'm Shafiq. I'm a vlogger and trader, and today I'm sharing my best kept trading secret with you. I trade in local and global markets while on the move or even when I'm sleeping. I was one of those who were clueless about trading, but today it's all at my fingertips, 24/7, and I mean literally. Here, I trade in equities and futures at ease, and most importantly, at real-time prices. Everything you see here is live. And there's also Live Alert allows me to take action when the price is right for me on the Bursa-listed stocks. When it comes to a trading platform, you really want one that is convenient and what works best for you, preferably one that offers better trading opportunities. When you see a good trading potential but you lack funds to trade, no problem. You have access to additional financing. The secret to being a good trader is not a secret at all. Once you have found the right trading platform, equip yourself to make informed decisions. Only the right trading partner will make sure of this. I truly appreciate the daily current updates by trading research analysts on the RHB Morning Cuppa at 8. It keeps me informed and up to date. With RHB Investment Bank, it doesn't matter what trading experience or strategy you have, your individual needs will be met. They are committed to you. And because of that, they are available for you anytime, anywhere, even when Malaysia is asleep and trading is active on the other side of the world. This multiple award-winning service is the right fit for any trader. It's even more rewarding when you can collect loyalty points for great rewards every time you trade. Nothing is more worthwhile than this. What are you waiting for? Download the app and start trading.
Good afternoon, ladies and gentlemen, and fellow investors. Welcome to our exclusive Zoom event today with the title China Outlook, Stimulus and Policy Easing to Buffer Recovery. But in addition and in response to the rapidly unfolding events in the Middle East, we have convened this additional session alongside our previously scheduled webinar. We understand that the ongoing conflict at the Gaza Strip has profound implications for the global landscape. So, and in our commitment from RHB to provide you with timely and critical information to navigate these challenging times. So, joining us today, apart from Mr. Jee Toon from RHB Asset Management. So, for the first session is our Head of RHB Retail Research, Mr. Joseph Chai. He will share with us the impact. He will share with us the impact this situation currently can have on the markets, global affairs, particularly on critical elements such as oil prices and affected sectors. So, without further ado, let's dive right into the session. Let's get started. Joseph, over to you.
All right. Good afternoon, everyone, especially my fellow colleagues. Also to everyone that logged in this afternoon. To my fellow colleagues from all the regional side and also all the audience from no matter where you are today. So I just want to take this short 10-20 minutes to actually talk about this Middle East conflict and how it's affect our sectors, particularly on the Malaysia equities. And so let's catch up with what we have know so far. All right, I think a very direct. We should see some oil price. We should see an upside risk so far. But I just want to recap that for RHB house view, especially view from our economist desk and also my equity analyst Sean Lim, right? Both actually see there's an upside risk on the oil price, or at least there's a very little downside risk on the oil price. Particular, there are three reasons here. Number one, the US economy is actually recovering very strong. You can see that the US on the last Friday, the job data have actually published a very strong set of data, and our economists actually have revised. Still see the US GDP going very strong. That's actually on the demand side of things, number one. Number two, right, and we do know that the Saudi, with the OPEC Plus, they have been actually curbed or actually lessen their supply to the market, and hence naturally, right, oil price, the supply side of things actually have a deficit right now. So with the additions conflict that we see today, the Israel between Hamas, right, and we know that Israel have declared war on Hamas, and generally when the Middle East have a conflict, right, the oil price will be more on the upside. Of course, in terms of equities market, right, when there is something very out of expectations happen, sentiments will become cautious or either risk off, right? But interestingly, as of yesterday, Monday, right, the war, or so-called the conflict or war, happened on a Saturday, and then we have Sunday, and then the market opens on Monday with China, US, Malaysia, and all open on Monday. I can see that the market is actually bullish so far from Hong Kong all the way to US, right? So it shows that the traders are not that jittery, right, pertaining to the equities market. So far, the sentiments are quite calm, right, regards on the equities market. And of course, today we know that Israel have called up their 300,000 reservists, and they are trying to block out the Gaza Strip, right, which I think they can't continue this for long, as Gaza is running out of food, medicine, and that there should be some basic humanitarian needs to actually send to Gaza. And one message and one news that actually I read, and I think this statement is actually very important, is actually how Saudi view this whole thing. And Saudi have actually, of course, they choose to stand by with the Palestinians, and they call for the de-escalations between Israel and Palestinians. Now, this message actually gives me a comfort that this thing will not go on for long term, and the conflict may not spread to the whole region as a whole, right? So let's actually digest a bit on this news, understand the relations between them, right? I'll talk about that later on, but just want to share a bit on midterm impact, right? The higher oil price will lead to higher inflations, as we all know. Right now, the World Central Bank are trying to battling the inflations from US all the way to Malaysia, and I think even Indonesia and Thai, right? And just that the US have actually, the FOMC has sent a message that they want to keep the interest rate at the elevated level for a longer period, which means we are not going to see a rate cut this year, and some more next year. The rate cut will be pushed back, right? Initially, we think that it will happen on the first half of the year, but it looks like it's going to happen in the second half of the year. It may be in a Q3 or even later than a Q4, right? For just a little bit of midterm impact, most of the oil upstream players will benefit from a higher oil price as they pump more oil, and then they actually make more money from that, right? And one fundamental news that we need to realize that market currently is actually facing a supply deficit. And if you look at not only the Saudi have actually cut their supply, you look at the oil rig in the US, which are published by the Baker Hughes, you can see that the number of oil rig count in the US has been actually moving downwards in a downward trend. So naturally, there will be an support, right, for the oil price, and generally that there's still a very little downside risk on the oil price, right? Furthermore, right, past few years, most of the oil and gas producers have actually what we call underinvestment. If you look at the Petronas activity report, they have mentioned that they continue to spend on capex, and I think that this actually, if you are in investment, right, these are the message that you can see that for RHB, we are still overweight on the oil and gas sector. right? We think that Petronas will continue to spend, and that will actually benefit some of the Petronas contractors player that are listed in Malaysia market, right? And just to also actually talk a bit on the this Saudi, right? Recently, there's a talk between G20 and the Saudi with the recent concluded G20 meeting, right? During this meeting, they have proposed this corridor between the India and Middle East, right? They want to build a corridor between India and Middle East to also include a rail network and also a fiber optics network that connect these few countries. See the countries: India, Saudi, UAE, Jordan, Israel, and Europe. So you can see that this is actually their plan. And if this plan were to actually go through, what happened is that Saudi need to normalize their ties with Israel. So far, we know that in the Middle Eastern, there are two big superpower. Two big major player. I wouldn't say superpower. Two big major player. One is Saudi, of course. Another one is Iran, right? And you can see that this the Middle East corridor, the purpose is actually to counter the influence of China, One Belt, One Road on the Middle East. And for this thing to actually go through, Saudi has to normalize its ties with Israel, which means they need to build relations with Israel. Just to recall, Israel have actually normalized their relations with Saudi neighbor, which is the UAE and Bahrain, through this Abraham Accord, right? That is going to improve the economic ties between these three countries. Now, you look at all these names in the country, you can see that that actually have influence of the US, which means all these things actually comes between the relationship of these four players, the US, Saudi, Iran, and China, right? So it's safely to say that when this conflict between the Israel and Hamas actually happens, and Saudi have no choice but to choose a side between Israel and Hamas. I think most of the observers have said that generally they believe Saudi will choose to side with Hamas, the Palestine, and that will actually jeopardize or the Saudi is very hard in the near term. It's very hard for the Saudi to have actually to build a relations with Israel at this moment. And why the Saudi have a need to actually build a relations with the Israel? That's another factor. Is recently Saudi have actually throwing out message that they want to build their capabilities in the nuclear. Right? They did not mention it's a nuclear weapon or it's actually a nuclear reactor, right? But it's something to deal with nuclear. And as we know in the world, this superpower, China and US have a capability in nuclear. And according to the news, Saudi is more leaning towards the US technology so far, right? So that's actually, with all this message that we gathered, right, safely to say that this conflict between the between the Israel and Hamas, right, will not be spread over regionally. Of course, as of now, Iran stand to be indirectly benefits from here, which the competitor Saudi, right, will not get the nuclear probably in this short time, right? So actually, that's actually people are saying that Hamas, what they are doing is actually sabotaging Saudi, because they just worried that if Saudi, right, really build a relations with Israel, right, that's where the Palestinian may be sacrificed, right? Some of the talks that they want, whichever struggle they want to have, right, may be jeopardized. So that's actually what market have been talking about. And based on all these informations, I think the conflict will resolve in soonest as possible, right? And for technical view, we are in a short term. We have bearish bias on the oil price. You can see that for the oil price, we have actually reached the supports and actually going for corrections right now. But because of due to this conflict happened in the weekend, the oil price have actually jumped. And right now we see a resistance of $90 as a turning point. So if the oil break above 90, then on they resume their upward trajectory. Else, if it stay below the $90, oil price will continue to find room for consolidations. And these are some of our house view on the GDP forecast. So far, we did not revise our GDP forecast. We are still looking at US at 2.5% this year, and Malaysia still 4.3%. And we see a very strong recovery in the US. And as for the CPI, the trend has been actually coming downwards. But of course, as we all know, the FOMC thinks that things are not stabilized yet. They have not seen a very strong evidence that US labor market is still very strong. Near term, the PCE is not going down to 2%. Based on these two things, FOMC has been saying that they are not hurried in cutting their rates, and they're also still tightening their monetary policy so far. As for the, you can look at our report. These are economist reports, and as for if you are living in Malaysia, right, we are economists think that this year, right, ringgit is going to be at range of 470, 480, and next year it will come down to 460, 470, right. As for the sector-wise, we are still overweight on the oil and gas, overweight on the utilities, healthcare, basic material, property, constructions, right? Nothing much change on the Monday event, but just that if you are a Malaysia investor, right, we do know that this coming Friday is the budget 2024, right? Out of the budget, what are the sectors that we are looking for, right? Recently, the government have announced the new initiative in the NETR, NIM, right? The NETR, New Energy Transformations the roadmap, and then the NIM, New Industrial Master Plan, right? And so these are things that, especially the New Industrial Master Plan, we want to see more detail that actually furnished by the government, right? I think that through all these sectors, I think we are quite we want to see the government to do more effort on the green energy, right? So I think just wait for this coming Friday, right? Of course, we are still also bullish on the property, right? You can see that today some of the property stocks start to actually move again, right? Hence, I think for the big cap stocks, much will happen on this coming Friday. As for the topics, we are still remain on topics from Sambi, Dayang, Gamuda, Hong Leong, all these are our topics right now. Now, in case that you want to, before I go for the small cap picks, I just want to share with you, right, in the short term, right, of course, FKRI will still see a bearish bias until it cross above the 1468.5, which is the recent resistance, right? As long as the FKRI stay below the 50 and 200 days moving average, the best we have the technical advantage. Then on CPO are still going for a downtrend. As of this afternoon, you can see the MPOB have released the September statistics. It shows that the FCPO for the September, the export are still slightly below expectations, right? The inventory has been built up, and I think that there should be some downside risk in the afternoon when the market resume afterwards. So nevertheless, we still keep our bearish bias on the FCPO, right? We keep our stop loss point at 3930. You can see that despite that the oil price have jumped 4% during the Monday sessions, the CPO did not follow suit, right? Most of the market participants are still waiting for the MPOB data, which have just released just now during the lunchtime, and the export number just below expectations. Okay, so these are some of the technical pick. In case you are looking for some of the trading ideas, we have these are the names that I actually have prepared for you, and during the weekend we have also shared with during our this Bursa event. So under the coverage, these are the stocks that we are looking at. Some of property names are UMS, LBS, Masing, Tenaga, Solarvest, Dayang, and we do have a trading idea that we have published throughout the year. These are the 5 reports that we have published And these are some of the technical picks that we have also published under our technical reports. Okay, so I think I'll stop here, and then maybe we can take one or two questions.
Okay, thank you, Joseph, for the insight. A lot of info within 15 minutes to digest. Okay, maybe just one quick question, Joseph. Who are the upstream players in Malaysia?
As of now, the upstream players like Petronas, but too bad they are not listed. Another listed upstream player would be Hibiscus, right? And there's also another sector which is FPSO player. I would consider them, the FPSO players are people like Insen and Bumi Armada. So these are the players. Right. As for the FPSO, we still have a buy rating on Armada and also the Insen. As for the other oil and gas players, we also have a buy on the Dayang, which their contracts are mostly from Petronas.
Okay. Due to time constraint, Joseph, I can only have one question for you. We need to move on to the to the next speaker and the next topic. So thank you for your time, Joseph, for the interesting sharing. Okay, so just a quick announcement for tonight. Join us for a not to be missed webinar from 8 p.m. till 9:30 p.m. Where David Chong, our RHB research top banking analyst, will not only delve into the mastering of the art of investing in local and global banks, but he will also shed some light on the spillover effect on the current Israel-Hamas conflict on global, and also how it affects the global and also the local banks. Also, make sure you join us tonight at 8 p.m. live on RHB Retail Equities Morning Kappa at 8. Okay? All right. So, moving to the scheduled main event, right? The title for today is we are talking about the China's economic outlook. So for today's session, we wish to gain unparalleled insight into the latest economic landscape of China. And our distinguished speaker for this session is none other than Mr. Jee Toon, CFA and the Chief Investment Officer of Asia Pacific Equities at RHB Asset Management Singapore. So with his extensive expertise and experience, he will guide us through the intricate details of China's economic dynamics, shedding light on the latest stimulus measures and also policy easing that are shaping the future of this economic powerhouse. And also joining our panel of moderators will facilitate the discussion to ensure that we cover every angle of this vital topic is Pak Berlian, Juveni Narayanto from PT RHB Sekuritas Indonesia, and also Mr. Tanapat from RHB Securities Thailand. Thank you for joining me today, gentlemen. So without further delay, I invite Jee Toon to take the virtual stage and kickstart our session. Jee Toon, over to you.
Thank you very much. Thanks, Alan. Thanks for that wonderful introduction. Okay, so the topic for today, I think it's obviously on China, and we're going to talk about stimulus policy as well as a whole host of other measures that we think will buffer the economy in China. But I think right now, the conflict over the course of the last few days obviously is causing substantial gyration to the market as we speak. So I think we can't talk about China without talking about what is happening to Israel at this point. I think Joseph has given us a very, very good introduction in terms of the impact that this Israel and Hamas conflict on the Malaysian equity side. So from my perspective, I guess what I can value add is also maybe try to widen up that perspective. So we will maybe talk a bit about what's the impact on global, on Asia, and on China, and also geopolitical implication in general. And then subsequent to that, we will tie that back into how this would affect Asia and also to China. So I think the immediate impact of this Israel-Hamas conflict can essentially be broken up into two aspects. I think one, as what Joseph has mentioned earlier, would be the prices of oil, right? So that is the immediate impact, and you have seen that oil prices have gone up roughly about 3 to 4% over the course of the last 2 days. So there's obviously a knee-jerk reaction, despite the fact that no oil supply has been affected at all at this point in time. But nevertheless, obviously, once there's conflict in the Middle East, I think the knee-jerk reaction is for oil prices to have an uptick. And this is what we are seeing over the course of the last 2 days or so. But having said that, I guess the silver lining here is that if you look at the uptick in oil prices, it has been fairly restrained. Like I said, only up 3 to 4%. And it's also, we have to bear that in mind that over the course of the last few weeks or so, it has been on a steady downtrend from $90+ all the way to about $85 at its recent low, right? So this restrained uptick in oil prices, I think is key to why the markets in general has been quite muted in terms of its response to Israel war with the Hamas at this point in time, right? Because the transmission impact of this Israel-Hamas conflict will predominantly be through oil prices. So if you want to look at, what is happening to the Israel-Hamas impact, for us sitting out here in Asia, I'm sitting in Singapore, all of us sitting in different parts of ASEAN, I can probably give a suggestion that you should look at the oil prices as the canary in the coal mine, meaning that this will give us an indication of what is happening to the Israel-Hamas conflict and how that is going to impact the rest of the world. So the oil prices is the immediate impact. Okay, so like I said, it's been quite well contained. So therefore, if you look at the share prices of the market over the course of the last 2 days in totality, I think the market is in fact up for most of the countries in Asia. Okay, so that's one. And the other impact is obviously on sentiment, right? A war is obviously very, very unfortunate, very, very sad in general in terms of the cost to lives. But in the financial world, a big implication would be on the sentiments itself, right? Definitely risk off. We have seen US dollars strengthening as a knee-jerk reaction. We have seen bond rallying as the flight to safety or curl yields have come back down considerably as well. So these are the two main impact. One, like I said, oil prices. The other one is through sentiment, right? So I guess for us who are investing in Asia and in global assets, what I can say is that I think so far the financial response or the market response, equity market response has been fairly restrained and fairly logical, right? Oil sectors have more or less rallied anywhere roughly between 3 to 5% across all the markets that we look at, which is obviously very, very sensible. Anything that has oil as an input would obviously suffer. And we have seen airlines in general been on a downtrend because obviously higher oil prices and higher geopolitical uncertainty probably doesn't bode well for the airline stocks. So in general, the market movements have been fairly logical. We haven't seen widespread panic, which is, for us as investors, that's something that we have to worry about. So far, so good. We haven't seen any widespread panic. So the share price movement has been very, very logical, right? In fact, Asia, to be fair, have actually weathered this very, very well, right? So maybe I can talk a bit about the impact on ASEAN in Asia and also to China. So I guess the immediate impact, like I said, will be on oil prices. So if oil prices were to go up, so right now, like I said, 3 to 5% is still quite well contained. But if, let's say, oil prices were to hit 100 or beyond 100, that will be a negative for inflation. The inflation pressures will obviously start to tick up because the recent reduction in inflation pressures have been led by the decline in oil prices, right? So if that were to reverse, then we would have an issue with inflation, and that will obviously be good for countries in ASEAN that it has exposures to oil, or to sectors in ASEAN that has exposure to oil, like for example, PTTEP, for example, an upstream oil player, or CNOOC, an upstream oil player, will obviously benefit in such a situation, right? And also in general, oil or energy linked counters would obviously also benefit, in line with the oil prices increase if, let's say, oil prices hit $100. But we are not seeing that. And the other thing is also in terms of impact to Asia and to ASEAN in general, right? In terms of the sentiments, in terms of the general risk of, if let's say the conflict between Israel and Hamas were to spread, then ASEAN, in general, it's seen to be a bit more insular, right? We are more dependent, I guess, apart from Singapore. Most ASEAN countries in general are more insular, right? We are driven mainly by our own domestic economy. So in times of trouble, especially in times of geopolitical turmoil, I think the flow would find itself back to places either to safe haven or to countries or regions whereby it's a lot more insular, right? So these are the two general impact that we can see, right? So, and having said that, that's on a relative basis, right? Relative in terms of money will flow around the world. The markets in general may be impacted if, let's say, this conflict spreads. But like I said, what we are, I guess, the silver lining right now at this point in time is everything seems to be very well contained, right? And we can talk a bit about the secondary impact, right? The secondary impact of this whole conflict will only be felt in weeks and months to come, right? And over the next 1 or 2 weeks, we will start to see that happening. If, let's say, this thing escalates, or if this whole conflict spreads. Like I said, the oil prices seems to be well contained, but let's see how that goes. But inflation were to be affected because of sustained levels of oil prices. I think what Joseph had also mentioned earlier. I think our view is also similar, that we are actually in an undersupplied situation, right? I think the OPEC, Russia, Saudis are in a situation whereby they're more than happy to control supply, to keep oil prices at sustained high levels, right? So that's one. And that will obviously impact the views on inflation as well as on interest rates, which we can talk about. So the bond yields have actually gone down because there's a flight to safety, right? That's knee-jerk. But we have to see, like I said, how this thing pans out over the course of the next few weeks or so, right? And also related to flight to safety, inflation, then we have to talk a bit about the interest rates hikes. Whether is it, are we going to see one more rate hike, or is this it? And also, how many rate cuts are we talking about for next year, which we will talk about we'll talk about later. And also, what I find interesting is over the course of the last 2 days, right, the US Fed governor have come out and start talking, right, and they have sounded very, very dovish, meaning that they are talking as though that there is less likelihood of an interest rate hikes. So that's what we mean by they have been sounding dovish. And that's why one of the reasons why the market has also been quite buoyant as well, despite the fact that obviously we have this conflict staring right at our faces, and it's just days after this whole thing have happened, right? So this is one of the reasons why the market is also have been quite buoyant. And however, I also want to talk a bit about some of the key considerations that we have to think about over the course of the next few weeks and months. Well, I actually had a call, sat in a call with an ex-head of Mossad, which is obviously the Israeli intelligence service, right? So just want to share some of the views that I think are quite interesting. Right. So I think what is interesting is that obviously this, even from the Mossad perspective, this has been a massive intelligence failure. Right. So this is totally unexpected. And what is also interesting from the perspective of Mossad is whether Iran's involvement, how deep is Iran's involvement. But so far, if there have been conflicting messages, right? The Americans are saying that Iran are involved. However, we have yet to hear Israel coming out hard on this statement. I think it's also very important to understand that in view of the geopolitical situation that is happening at this point in time, right? One is that prior to this attack on Israel by Hamas, peace was actually in the making in the Middle East. A reason is because there was a China brokered deal between Iran and Saudi several months back, and also the recent Saudi-Israel deal that is being brokered by the Americans, right? So, prior to Saturday's events, right, you can arguably say that peace was returning, or it was going to be a lot more likelihood of peace happening in Middle East was actually getting higher, right? But obviously this complicates matter, and obviously Israel role in this whole situation will be key, right? And also Hezbollah's involvement or not in this whole event will also be key, right? So, but what is we can say for sure is that over the course of the next few days, I think Israel will go in very, very hard in the Gaza Strip, right? And how the Arab nation respond to that will be key, right? So, like I said, we are not political experts here, and it's also very, very complicated, right? It's the Israel situation, the Middle East situation is very, very complicated. So it's very hard for us to give a very strong call here. But I would say, look at the oil prices. I think oil prices will probably reflect a lot of these fears if anything were to happen with this Israel-Hamas conflict. However, I just want to also end off by saying that this Israel-Hamas conflict is very different from the Russia-Ukraine pertaining to how it affects our parts of the world. Right? If you can remember, just rewind back the clock. When Russia attacked Ukraine, there were talks about China attacking Taiwan. So that was a common inference that was being made by the market at that point in time. But in this situation, I think there's less of a case to link this conflict with the China-Taiwan conflict, right? A potential China-Taiwan conflict. So this is something that is very different from the situation compared to the Russia-Ukraine war. And also, right now at this juncture, it seems to be quite well contained, right, within Israel at this point in time. And also, moving on, I also want to bring our attention back to what is happening in the real world and how is the market looking at this. So right now, I can share with you this chart it's a bit messy, but I just want to highlight what are the key points that what the market is saying at this point in time. The market is saying that there's only a 35% chance of another interest rate hikes, especially in view of what is happening to Israel at this point in time, roughly 35% chance, right? And with the dovish statements made by the U.S. governor over the course of the last 2 days, right? So in fact, I think people are expecting, probably we are looking at maybe, current Fed fund rate as the peak of Fed fund rates, at least for this cycle. And also people are expecting roughly about 3 rate cuts in 2024, right? And I think that is something that we have to start thinking about in terms of participants in the market, because when rate cuts come, and it should come in 2024, then the markets should respond accordingly as well, right? And we can tie it back to how it's affecting the US. So this is the chart of US CPI, core CPI and headline CPI. You can see that CPI is in fact coming down quite nicely. So this is in fact what the Americans or investors would view as a Goldilocks scenario, meaning that CPI is coming off nicely. But having said that, if you look at on this chart here, the non-farm payroll has been very, very decent, right? So that's why it's a Goldilocks scenario, meaning that the Americans are able to come up with a soft landing for its economy, despite the fact that we have 550 basis points hikes already over the course of the last 12 months or so, right? So this is something that I think it's comforting to the market, and that's why you've seen that the market has been quite resilient, especially the US markets, and also markets in our parts of the world are starting to find a floor, right? And also in terms of ISM data, both for service and for manufacturing in the US, you can say that it's less bad now, even for manufacturing. Manufacturing has been in a downtrend for a long time, since September of last year. But right now, we can see that it's probably bottoming out as well. And also in terms of service PMI, which is one of the main reasons behind the wage cost inflation, service PMI continues to be on the uptrend and an expansionary phase. So that's why I think people are looking at it and say that I think US are able to stick a soft landing this time around. And in terms of the US dollar, it's important for me to highlight that as well. I think we have seen probably the worst of the US dollar, meaning the strongest part of it, which was in late last year. So recently, there have been a recent uptick because of the fact of the conflict, flight to safety, flight to US dollar that has happened. But I think that probably we have seen the peak of the US dollar, and that is usually beneficial to Asia and to emerging markets in general. Okay, and also going back to the US on the WTI, which is West Texas Intermediate oil prices, you can see that we have seen a decline from the highs that we saw. And right now, roughly $80+ is something that the market can probably stomach. And our view is also consistent with what Joseph had mentioned earlier. We are also quite positive on energy prices, and also mainly because of this, even prior to the events of last weekend, Saudi Russia extending the oil cuts to the end of the year is obviously very positive to the oil prices. And we do think that having an exposure to oil is probably the wise thing to do going into the end of the year. And obviously over the course of the last few days, that has made a lot of sense. Okay. And however, I also want to highlight to everybody that we need to look at oil prices, because oil prices has a very, very strong correlation to inflation expectations, right? As you see from this chart here. So therefore, we need to watch out for oil prices, because if inflation starts to trend up again, then we may start to see interest rate hikes coming back. But right now at this juncture, it's still well within expectations. So I don't think the market is seriously worried about inflation in the near term, right? But having said that, geopolitical events, sometimes could be highly unexpected. So this is something that we have to watch out for. Okay. Next, I also want to touch very, very quickly on the China macro indicators, right? So on this chart here, I just want to highlight the Chinese PMI, or the Purchasing Managers Index, for both for manufacturing and non-manufacturing. So you can see that the manufacturing, which is these two lines here, the two lines in white, one is the Chinese manufacturing and the other one is the China official ones. You can see that it's also starting to bottom out and starting to trend back into an expansionary territory, right? We have seen a knee-jerk uptick because China reopened very quickly last year. So we have seen that. But over the course of the last few months, the market have digested that, and also we're starting to see PMI starting to trend up as well. And in terms of service PMI, we have seen this very, very strong knee-jerk reaction, because once China opens up, then we can see a big, humongous uptick in terms of service requirements for service. You go out and makan with your friends, with your family, go to restaurants, go and watch a movie. All these things all happen over the course of the first quarter of this year. Then we have seen some form of normalizing, right? So I think over the course of the 9 months or so, they've probably had enough of restaurants, eating, movies, and all of that, right? We're starting to see a form of normalization. Okay, and this is also reflected in the retail sales. We can see retail sale uptick from the December end of the zero COVID policy in December, and also we can see very nicely that the industrial output has also been trending very nicely. But it is normalizing. We're not going to see the high trends that we saw in the first quarter of this year, because that was more of a debottlenecking, right? A release of pressure, and we have seen that normalizing over the course of the last few months. And also in terms of inflation trends, just want to highlight to everybody that in terms of the PPI and CPI in China, it's well under control, very much lower than what we see in the US, and therefore China does have a lot more stimulus and policy measures that they can pull, right? Unlike in the US, we have to worry about inflation, so they can't really stimulate the economy, even if the economy is in a downtrend because of inflation. But in China, it's a different story altogether. So that's why our view is that with the CPI, PPI well under control in China, the Chinese government are able to stimulate the economy both in terms of consumption as in terms of property sectors. And we've seen that happening over the course of the last few months. And very quickly, I also want to touch on a few key themes which I think are very interesting, that I think investors should take note of. One is that the July Political Bureau meeting, the senior leadership in China made it very clear that stimulus measures are to be expected and will be enacted, right? You can see that the measures are quite broad-based, from stimulating of domestic demand to stimulations of private sector investments, as well as the property sector, right? So I think these are a major sign that the Chinese government is pulling out all stops in terms of trying to stimulate the economy and trying to buffer the recovery, especially in view of the overall weak economic environment that we are seeing in the US, which is obviously trying to engineer a soft landing, and Europe, which is obviously being impacted by the Russia-Ukraine war, and now with this whole Middle East uncertainty. So I think China is in rare position whereby they are able to enact a whole host of policy measures that enables them to stimulate and buffer the nascent recovery that we have seen. Okay, and however, I also want to point out very, very quickly, I'm sure all of you are well aware of what is happening in the Chinese property market and the recent problems that they have. However, I just want to point out to everybody what is happening here. What I've highlighted here is the residential property prices trends, not just for first-tier cities, but also for second and third-tier cities as well. So you can see over the course of the last 6 months or so, you can see that the market have seen the worst. Even the third-tier cities, which I think is quite useful in terms of trying to, for us as investors to figure out what is happening to the overall economy, because they are in a more oversupplied situation. Obviously, demand is not as strong as what we see in the first-tier cities. In the third-tier cities, yes, they have bottomed up tremendously. So anything below this dotted line means that it's negative. On a year-on-year comparison perspective, they are in negative territory, meaning that the property prices are down, right? And even for third-tier cities, they are starting to see bottoming up already. They are still down, but less down, right? Same thing we can say for the second-tier cities. It's also starting to bottom up quite nicely, right? And in the first-tier cities, in general, they are still on a downtrend, but still positive. Okay, and however, I also want to very, very quickly touch upon this, which I think is the Huawei 5G Mate 60, which I'm sure all of you are quite well aware of. I think the surprise launch of this Huawei Mate 60 and also the timing of it during Raimundo's or the Commerce Secretary visit to China was definitely very, very impactful, right? So our view is that in the actual fact, I think this actually caught the market by surprise, because the Huawei Mate 60 was not even supposed to happen, because of the fact that the Americans thought that by having this technology sanction, China would not be able to push forward on its 5G ambition. But I think it's quite amazing that Huawei managed to prove them wrong, and they are launching or have launched the Huawei Mate 60. And just to share with everybody, right? So practically every part of it is made in China, which is a big departure from the previous series. and more surprisingly to American especially, was because Huawei was on a sanction list. So technically speaking, they can't get access to any of this American or Western-made technology, and yet they are able to produce a 5G phone. And obviously, we have seen how successful this phone is. I think the Chinese have been buying this phone, I guess, from a variety of factors. One, patriotism is one thing. Second, also because of the higher specs that they can enjoy because of the Huawei Mate 60. Right, so I think it was sold out on major, within days, within hours after it was launched. So our view is that I think this is something that has caught the market by surprise, which I think is quite positive to the Chinese investors in general, because it shows that the Chinese are able to break up to a certain extent from this 5G or this technology sanction that has been imposed by the Americans. Right. So bear in mind that, like I said, the Huawei is supposedly completely out of the Western technology ecosystem already. And for them to pull this off, I think it's amazing. So that's why I titled this The Rise of the Phoenix. Right. So moving on. We just passed the Golden Week, which I think is very instrumental in helping us understand what is happening to China, what is the consumption appetite for the Chinese. So it's a mixed bag from what I can see from the data, and here I can show you a sampling of what I'm looking at. If you look at tourism in general, domestic tourism in particular has been very, very strong compared to 2019, which is pre-COVID levels, right? Rail traffic is up roughly about 30%. Air traffic is roughly up about 10%. Domestic traffic trips or domestic tourist trips is roughly up about 5% compared to 2019, right? And in general, the spending per domestic tourist is back to 2019 level, right? 2019 level, right? So we can say that the Chinese are spending, but they prefer to spend it onshore rather than spend their money overseas. So outbound traffic, for example, is about 15% down compared to 2015 levels. Property sales, we know, is still down, roughly compared to 2019 levels, roughly about 27%. And movie tickets, for example, are down roughly about 45%, right? You can see that the Chinese are also modifying the way that they're spending their money, right? Less of movies, more of traveling, more of experiences, right? So, if you look at the data that's coming through, our view is it's a mixed bag, right? It depends on how you look at it, is whether it's half empty or half full, but depending on where you are invested. So for us, we have invested in the Chinese domestic tourism space. So this Golden Week has been quite helpful to the portfolio from the perspective that our stocks have done well because the domestic tourism in general has been a lot more supported by the local Chinese. Okay, and on this chart here, this is just a sampling of the data of photos that I took over the course of the last few days. You can see, Changchun was full to the brim. Shanghai, the Ban area was full to the brim. So these are photos that I took off Weibo, right? These are, so you can see that, people are spending, people are traveling, right? However, you notice, but they're not traveling to outside of China. Right, so within China, tourism is very much preferred, right? And also, I also want to talk a bit about the US-China tension, right? Our view is that I think the Americans are doing their best to try to mend fences, right? So over the course of the last few weeks, months, right? From June, Blinken was there in China in June, meeting with Xi Jinping. Yellen was there in July, and Raimondo, the Commerce Secretary, was there in August. Right, and there are talks that I think right now in China, the senators are there in China right now, and Xi Jinping was supposed to meet up with them soon. Right, so there have been high levels visits to China recently. Right, so I think it's also interesting from the perspective that I'm sure all of you are well aware of the US-China tensions, but we are starting to see high levels visits to China recently as part of the, I guess, senior leadership efforts on both sides to try to mend fences as far as possible. It's not so easy for both sides to decouple from each other, frankly speaking. So even though they Americans are trying their best, right? And also, like what I mentioned earlier, the Chinese are also exercising their own diplomatic muscles overseas. So that's why, in this chart here, in March of this year, they were the ones who brokered the deal between Saudi and Iran. And I think we should be, glad that they did, and because I think that was so very helpful in this current scenario, whereby there's a lot of things happening in Middle East, and it's important that there's as many regions that are being mended as as possible. The Americans are also doing their bit with the Saudi Israel situation. Okay, and also just to conclude, I just want to highlight to everybody how cheap the valuation is, right? So right now in China, we are looking at valuation that are as cheap as what it got close to the lows that we saw during the COVID in 2020, right? And similar to Asia in general is also not expensive at all, very close to what we saw during the lows of COVID. So I think that the Chinese and Asian equities in general are very positive from a valuation perspective. Okay, with that, I've come to the end of my prepared remarks. Maybe I'll hand it over to Alan, and maybe we can have some Q&A.
Thank you, Jee Toon. Interesting presentation. Okay, there are some questions that's coming in. Let's start off with. There's a few questions asking about the property sector in China. Let me just summarize it. Okay, there's Jeff Tan in the Q&A box. He's asking about China property crisis of Evergrande. Has it been resolved? And also there's the other question, which is more elaborate, also related to the same developer. The Chinese government is determined to help the developers. But do you see the developers manage to stay afloat and build more housing projects? Especially what happened to Evergrande founder, which was put under house arrest.
Yep. Okay. Very, very good questions. Okay. So the short answer is, right, it depends. Problematic, right? So in fact, for most of the private developers, it's going to be problematic, right? As you can imagine, those of you who have been keen followers of the Chinese stock market, you will know some of the richest tycoons in China were in the property sector. So they bought football clubs, they have huge palaces for their homes. They have huge, beautiful offices, which I've been to, beautiful offices, skyscrapers, and obviously a lot of them have been very imprudent in terms of their spending, right? So all these are coming back to bite them at this point in time. And in a lot of cases, right, they have raided their company coffers, right, for their own personal benefit. Right, for all of these tycoon, there's no such thing as company accounts and their own personal accounts. Their own personal expenses could be financed by the company. We have heard stories about private jets, and obviously very, very decadent lifestyles. Right, all these are coming back to bite them because the Chinese government is making them personally responsible for the debts of their companies. And in a lot of cases, because these are all private companies, these are all private entities in terms of their own holding companies, but the listed companies are obviously subsidiaries. It's sometimes very difficult. The private companies are okay, but the holding companies or the public companies are left holding the baby. So what the government is trying to do is trying to make them personally responsible to get their own private holding companies to come out to stump up money to pay for what all these problems that we are seeing in this private listed company. Obviously, it's easier said than done because technically speaking, these two things are separate, right? The public listed companies are owned by shareholders, right? Why should the majority shareholder come up with own private companies to pay up, right? But we know things are obviously not so simple, right? So a lot of things are all complicated. It's all mixed up, all quite complicated. So the Chinese government is trying to make them responsible, to try to make them personally responsible for the problems that they are in the property space. So we are seeing stories of these tycoons getting house arrest, or they're getting remanded. All these things are happening, right, as a way of trying to resolve this. Okay, but let me also share with you the overall mix of the Chinese property sector. So roughly speaking, 40% of the sales in the Chinese property sector is by the SOEs. These are state-owned enterprise, very well run. Very, all things are done by the book because it's all quite well run. It's owned by either the central government or the big provincial government. So all these guys are still doing well, right? Because they have this implicit guarantee, and in all fairness, they have run their balance sheet very well. So they are not in any trouble. So the market, the financial market, the bond market are still open to them. The banks are willing to lend them. Bond markets are still okay. So for roughly they contribute roughly about 40% of the total sales previously, right? So those guys are still chugging along very nicely. So roughly speaking, they are about 20% of the company, 20-30% of the rest, right, are poor quality private developers. Those guys are in trouble. Balance sheet is in very bad shape. Evergrande is one of them. So just want to highlight, we've never invested in Evergrande over the course of the last 5 years that we've been managing this portfolio. The reason is because we know of their problems from day one, right? So we've never been involved at all with the company at all, right? So these are well known, and the problems have finally caught up with them. So this 30% of them, which accounted for roughly 30% of the sales, would be in trouble. So technically speaking, no one in their right frame of mind would buy from them. So immediately, right, that 30% of sales is out of the market. So even if you build, right, the Chinese people will not buy from you because they know who are the good quality developers, who are the property developers that are in trouble. If you push out housing by, let's say, for example, to 40% of the market, which is the SOE, they will buy because prices have come back down. And they are confident that the developer will be able to build and give them the completed properties at the end of the day, right? So this is a very, very different market that we're talking about, even though it's in the same sector. And then the rest of it, roughly about 30%, are those private developers, but they are high quality as well. But because they are private developers, they are also suffering because the market may not be open to them. The banks may be hesitant to lend to them. Or the bond market may be able to lend them, but at a higher interest rate because they are afraid as well. So these 30% are also, depending on who you are talking about, they can potentially be in trouble as well, right? So that is the situation that the market is facing at this point in time, right? So Evergrande, I think there's still a long way to go in terms of trying to figure their way out. We have never invested in them. We don't plan to. Right, there are also a few other weak private developers which I think we wouldn't touch also. We'll never touch them, and I think we won't touch them going forward too. Right, so the answer is, right, it depends once again. However, we are involved in some of the good quality guys because those guys will survive. Those guys, their property sales continue to be better this year. Are continue to be better than what they did last year. Right, so in fact, over the course of the last few months, right, we are starting to see development in first-tier cities starting to move already, right? Because the government have actually the government has loosened a lot of their policies. So we are starting to see that happening already. So we are in the bottoming out process, but stock pick is very, very important. Stock selection is very, very important. You have to buy the right stocks, right? If not, you're going to suffer. But overall, as a sector, I think the policy has been very, very loose. From very, very tight that we saw it last year, it has become very, very loose this year. Okay? So I hope I answered that question. Alan, over to you.
Yeah, thank you, Jee Toon. Okay, let's move on to the next question here. If oil prices continue to scale higher, how this will impact China as they are the consumer, one of the main consumer, right, rather than the producer?
Okay, so frankly speaking, the Chinese obviously it's import oil, they import energy sources, but recently, if you look at the papers, they have managed to get cheap gas from the Russians. Frankly speaking, India and China have managed to get cheap gas and energy sources from the Russian, right? So officially, it's these energy sources are out of the market for a majority of the developed market because of sanctions. Right, but for us, for our portfolio, we are trying to, or we have exposure or stocks who are able to take advantage of this situation, right? So that's as much as I can say, right? So the Chinese are getting cheap gases, right? Cheap energy sources at way below market prices, and these are on long-term contracts because obviously the gas from Europe, from Russia to Europe is probably out of the question, but the gas continues to be there. So where is the gas going to be piped to? Right. So obviously, we try to take advantage of this situation, right? Because end of the day, the gas has to go somewhere, right? And they are also, and to be fair, right? I think the Chinese are also very smart, right? They know that Americans cannot possibly control everything, because if they control everything, oil prices will shoot 120 just like that. If you sanction everything, so they can say what they want to do. The gas, the energy sources from Russia will not reach them, right? For those who wants to be, on that high moral ground, right? But the gas have to go somewhere. And they're also well aware that because if you totally control the gas, oil prices go to 120 and nobody in the entire market can tahan this kind of oil prices, right? So they can actually get their cake and eat it too, right? They can condemn, they can have the moral high ground, and yet oil prices continue to be at $80+, right? So this is something that I just want to highlight. This is the world of politics, right, coming to play in the world of econs and finance. Yep. Okay,
that's good to hear. It's a fact, right? Is that you have to balance out on the politics and as well as the, how they distribute all these gases and. Okay, let's move on to the next question. How high a probability that the government will open, you're talking about China, open to spur the economy like they did back in 2008? Are we going to see the kind of mega spending again?
Yeah. Okay, so the short answer is no. They will not see that mega spending. Why, you may ask? The answer is because no matter what, right, the growth rate is still decent, despite what the Americans are saying, or you read the foreign press, right? If you look at it, what is China's growth going to be this year? It's probably going to be 4 point something to 5, right? What is US growth this year? 2%, right? So no matter how you look at it, the Chinese government is also well aware that they are not in a situation whereby we're having negative growth. So why pull out the big bazooka when you're growing at 4.5% to 5%? The only country that can beat China in terms of growth, major country, is actually only India. And India is chugging along very, very nicely. But apart from that, right, it's China. So China is not going to go into a negative growth territory. So obviously, from a financial market, or those people who wants a market to just boom and then make as much money as possible in a short period of time, they will obviously ask for the big bazooka to be launched. But from a Chinese perspective, a big bazooka will come with its side effect as well, right? So from their perspective, they will do the loosening, the stimulus and everything, but it's very targeted. For example, they will target the property sector because they need to beef them. They will target the infrastructure sector. They will target the national grid. They will target AI. They will target the Chinese internet sector as key sectors that they want to stimulate. But the big bazooka that what we saw in 2008 is out of the question, right? Because it's not necessary. And also at this point in time, I think they have enough policies that have been implemented that will cause the Chinese market to sail along nicely. So like I say, I use the word sail along nicely because 4 to 5% is probably what the Chinese government wants anyway. No point doing 8-9%. No need to be a superhero when the whole world is in a recession. China alone cannot save the world, right? So they are going to do what is good for them. So 4 to 5 will put them in a nice position, right? Neither too hot, neither too cold. Enough for them to go to 4 or 5, and yet not big enough so that there's going to be a problem with over investments, right? Problem with speculations of assets classes and all of that, things that come with what we're seeing in America right now when the balance sheet is so bloated, right? So this is a difference that I think between now and versus 2008. Okay, Alan, over to you.
Thanks, Jee Toon. Okay, let's move to our counterparts in other regions. We go to Indonesia first. Berlian, you got a question for Jee Toon?
Yeah, thank you, Alan. Thank you, Jee Toon, for your presentation. many times in the presentation, you mentioned about we need to focus and to see, to watch out the oil price. Yeah. How would you compare the current situation to what happens in the 1970s? And of course, it's not only the oil price, but also the about the geopolitical matters, tension.
Okay. So one good thing about history is that once everybody experiences that history, chances are they tend not to repeat itself. It may rhyme, but it may not repeat. But because what has happened over 1970s, the government, central bankers are well aware of what might happen. So right now, if you think about it, they are also well aware of the fact that, energy prices is really on the uptrend, right? And if we are not going to see this massive uptick in oil prices, I think, right? But once again, geopolitics is very hard to say. But like what I say, I think what is good about this whole situation now is that, we have this situation whereby Saudi and Iran are talking, right? We talk about the Abraham deal, what Joseph has mentioned earlier. The US have tried to broker peace in the region over the course of the last few months. I think that's quite timely, right? And also the Chinese have also done their bit. So Iran and Saudi are also coming together. So the major powers, obviously, they disagree on a lot of things. Like, for example, major powers, I'm meaning US and the Chinese, but they are also trying to do their bit to make sure that the Middle East continues to be as peaceful as possible. And ironically, I think Joseph has also alluded to this. This is one of the main reasons why Hamas could be doing this. Because if there's peace, then they might be squeezed out of the whole equation, right? So that's also a counter argument to what is happening, right? But like I said, I'll leave the politics to the experts. So for me, I'm just here to make money for my clients. So what I'm trying to say here is that I think oil prices will remain strong, but we don't think oil prices will go crazy at this point in time, because I think the politics this time around is very, very, very different compared to 1970s. Right. So, but once again, like I said, geopolitics, anything can happen. One wrong person got killed. One bomb goes off at the wrong place. Literally all hell can break loose. So it's very hard for me to say for sure. But this is definitely something that we are looking at very, very closely. But so far, so good. And oil prices, like I said, right. So today, I think oil prices is on. I just looked at it just now. Is in fact down. Right. So which I think it's a good thing. Right, it's a good thing for all of us here, right? We all of us want peace and prosperity to all parts of the world, and it's very sad what has happened. Thousands of people have died, and hopefully they can get over and done with, and then they can move on to the negotiation stage, right? So yeah.
Thank you, Jee Toon. So for the following question is about how we can advise our clients in regards with the cash management or money management towards their own investment portfolio.
Okay. For me, right, I've been doing this for 20 plus years, 25 years. It's difficult to time the market, right? The best advice that I can give is when there's blood on the streets, when there's a war, as long as your view is that mankind will survive. We have seen, all of us have been through the recent one, which is COVID, right? Right in the middle of COVID in April, no vaccine, no nothing. We didn't know whether we will survive or not. And then that's when we started all this whole series of webinars and all of that, right? That was the best time to invest, when everybody thought that mankind would die. And the lowest of the market was April of 2020, which means Malaysia just started MCO. There's no vaccine, no nothing. And yet that was the best time to survive. So if the view is that in general, mankind will survive, capitalism is still the way to do things, right? Then the market in general will be on an uptrend for, so in times of trouble, when blood is on the streets, right? And Warren Buffett says it best, right? When everybody is fearful, you should be greedy. When everybody is greedy, you should be fearful. So in my opinion, that is probably the best advice out there. When everybody is worried about the market. Everybody is worried about China. Everybody is worried about the US-China tension. Is that the best time to buy, right? So I think that is obviously it's easier said than done, right? I'm 25 years in business. I do this every day, right? I also find it difficult sometimes, right? But that's why we have tools like, for example, valuation charts to help us, talking to people, trying to understand where the market is right now and what are our positioning. So right now, what is for us at this point in time? Okay, what is the key signs that we should invest? One, valuation is super cheap. In China, is as cheap as what it got during the COVID crisis. When, like I said, no vaccine, no nothing. Mankind didn't know whether we're going to survive or not. We're all rushing around buying toilet paper, finding masks for our family at that point in time. It's as cheap as what it was now. But is the world as bad as what it was then? So that's one. Right. Second of all, what is positioning? Are people over-invested in a certain asset class, in a certain region, a certain country? If that's the case, then you should run because everybody is in there. But right now, we know for sure that investors in general love to hate China, right? They have very light position in China. In fact, they love to hate Asia too. In fact, they love to hate ASEAN too. We see that in all our positioning. We have people from Thailand, Malaysia, Indonesia, and Singapore, right? We know, right, what are the foreign flows like in our parts of the world. It's very, very light, right? So we know they are not in. Investors in general are not in. So positioning, once again, is something for us again. So the other part we have to convince ourselves is there growth? Are we positive about our country? Are we positive about our region? Right? If the country can be China, can be Indonesia, can be Thailand, can be Singapore, can be Malaysia, right? Are we positive? I wish I could. I have the crystal ball and say that, you know what, tomorrow at a certain point in time, that is the lowest point in time in the market, and then we should buy. No one has that crystal ball, but we know that if we try to ease our way in, buying across time, right? I think chances are, if we look back 5 years from now, right, I think we look back and say that that's probably the best time to buy. Right. So these are the few things that I think are that I can say. But I do know for sure that the market is fearful. Right. If you, like I said, you go back to what Warren Buffett is saying, be greedy when others are fearful. Right. But like I said, it's easier said than done because it's all right down to here, right? Right. So yeah. Thank you.
Yeah, excellent. Jee Toon, thank you for the answer. Over back to you, Alan.
Okay, Berlian. Okay, we move to Thailand. Tanapat, any question for Jee Toon?
Yes, thank you, Alan. Thank you, Jee Toon, for the presentation. So my question regarding to the U.S. bond fund. Actually, as we see the crisis between Israel and Hamas, what is your idea for the client who invest in the U.S. bond fund right now?
Okay. So, like I said, I'm the CIO for Equities, but I'm also manage multi-asset funds. So I just want to highlight that my view is that bonds are actually quite attractive even at this juncture. Right. Reason is because if you look at the charts what I highlighted earlier, right, we are now quite close to peak interest rates. Let's say we use US as a gauge because US right now obviously drives all the bond yields all over the world, right? If US is currently, if you look at the market, you look at the what the market is saying at close to an all-time high, and we're looking at interest rate cuts next year, then I think we are in a great position for bonds, right? One. Having said that, one is because you can lock in, yields at a very high point. It's probably the highest yield that we have seen in decades, right? For those of us who have been around, this is some of the highest yield that we have ever seen. That's one key thing that could be in play. Second one is also obviously if right, the market is correct and the US starts to cut interest rate, be it 2 times, 3 times, 4 times, whatever, right? Then it's also good for bonds, right? Because once interest rates are cut, bond prices goes up, so you have a capital appreciation. So I think in from that perspective, right, and how we manage, because I manage multi-asset portfolios as well, which have equity and bonds. I mean that's how it's our view of the world. Right? It's like heads, you won't lose; tails, you win kind of situation, right? Right. So I think right now, and also bearing in mind that 2022 was a rough year for both asset classes. Right, both equity markets and bond markets were down 20+%. Right, so and once again, right, if going back to the same thing, if everybody is greedy, then you should be fearful. If everybody is fearful, then it's many times for us to be greedy. Right, so last year both asset classes, both equity and fixed income, were down massively. This year, right, I think it's maybe it's a time for us to take stock on that and try to take advantage of what has happened. Okay.
Thank you. And the following question regarding to the China, what are the biggest challenges that we expect to see for the Chinese economy in the next 12 or 18 months from now?
Okay. Once again, a very, very good question. I think the biggest one, you can think of it as internal and external. So let's talk about internal first. For internal, I think the big one is obviously property, right? I'm sure all of us are probably in the same boat. Our single largest piece of net worth is probably in our property, right? So it's the same thing for the Chinese. In fact, for the Chinese, it couldn't be, they may not have one property, they may have a few, right? Their parents may have a few. So a large part of their wealth is in the property market. And obviously, to be fair, a lot of them have bought very, very, very cheap. So they are sitting on a lot of profits, right? But having said that, no matter how wealthy you are, when you see that your wealth goes down or your property market goes down by 10%, you obviously you wouldn't feel so good, right? Would you want to spend as much as you did last year when when your net was at all-time high? Obviously, that's not the case. We have seen obviously the property market in China coming off. So in general, people in China are feeling poor. Whether they're actually poor or not, I don't think so, but they are feeling poor because their net worth has gone down, right? So it's all comparison, right? As long as you are less rich than what you were last year, you probably feel poor too, right? So even no matter how rich you are. So this is the situation that is happening in China right now. So the property sector is something that they have to deal with, right? We are seeing a bottoming. And obviously China is huge. It's also easy to just turn, right? Just turn, and then the property market will just turn 180 degrees. So we know that they are trying to turn. We know that they're turning slowly but surely, right? But it will take time, right? And property sector, to be fair, just want to highlight to everybody that the property market in China, they've been trying to clamp down since 2016 until 2022, right? It took them 6 years for them to deflate the property sector, right? So if you think about it, then for them to turn it up again, it's probably not going to be so fast, so it will take time. But nevertheless, I think they're making all the right steps. They're making all the right moves from my perspective. So that's one. And that's related to that will be all the sentiments that is happening, right? Once you feel less rich, then what are you going to do? Are you going to adjust your spending pattern? We are seeing all these things happening. We are seeing people downgrading in terms of their consumption patterns. So that is also happening as we speak. And we are also adjusting our portfolio over the course of the last few quarters. Why? Right? And also, last but not least, it's also on all the clampdown that has happened in 2022. The internet sector, the education sector. Right now, it's being open as we speak. But obviously, it's not so easy. Once you say policy open, it's not to say that within the next 2 or 3 months, everything will be back to normal. It's not. It's going to take time. So we are seeing that opening happening from end of last year until the first quarter of this year, first half of this year. We are starting to see all these things changes happening in the economy as we speak. But obviously, it will take time. Right. So all these things are happening and you will start to gather steam as time goes on. So this is what I can expect to see on the internal front. On the external front, that's more complicated. Right. On the external front, obviously the US-China tension. Obviously, that's not going to help. Right. Because the US is putting pressure. But what I can say is that they have put on the maximum amount of pressure already. Right. They have cut Huawei off from the supply chain. They put on all these sanctions. They cannot use the high-end semiconductor equipment from ASML. TSMC are not supposed to work with them. All these things are happening over the course of the last 3-4 years, ever since Trump's days, right? So that is obviously the pressure has always been there. In fact, I think it's already maximum already. And yet, so that's why I thought the Huawei story is quite interesting. Despite all this pressure, we know the Americans are surprised. Hey, how did Huawei come up with a mid-60? How did they come with mid-60? They took them by surprise. They have to go and open up the phone, figure out, hey, it's true that inside everything is from China, made in China. And that's amazing because no one country by right is able to produce a phone by itself. But having said that, like I said, so that part was the most important external factor. And yet, like I said, things are changing because we have a Huawei mid-60, the rise of the Phoenix, and also more importantly, you can't really do much more already because Huawei is already out of the system. 5G equipment is out of the system. You cannot do much more already because they're no longer using your technology supply chain, right? So how much more can you put on these guys, right? So once again, I think that we have seen that and we have reached a point of maximum, and it's good to see that the Americans doing all these things to try to mend fences. Right. So I do think that is something that we have to watch out for. But also, I also understand of politics, right? American presidential election is next year. The easiest thing for them to do is to bash China. That's the way to score easy political points. So I believe that pressure on the US front will continue to carry on. Okay.
Thank you, Jee Toon.
Yeah.
Thank you. Over to you, Alan. Thank you.
Yeah, thanks, Tanapat. Okay, maybe we just have time for one more question, Jee Toon.
Okay.
So, Jee Toon, have you got your Huawei Mate 60 or not?
I'm trying to get one.
Okay, the last question really. China coal prices have been moving up again. So any trading ideas from this commodity?
Okay, so I'm not allowed to give specific stock calls. So I will leave it to our individual colleagues in all the different countries to give you stock calls. But I would say that I will talk about my portfolio, the RHB Big Cap China Fund. We have exposure to the Chinese coal sector. The reason is because winter is coming. Winter is coming. Typically, there's a seasonal cyclical impact there, and also energy prices in general have been quite well supported. And with this recent geopolitical environment, I think energy prices will have another leg up. So that's why, in general, we are positive on the energy complex in general. And you combine that with the geopolitical factor plus the fact that winter is coming, I think all this makes up for an interesting mix. Okay.
Okay. So I think that's the time that we have for today's session. Actually, there are a couple of more questions, but we are seriously running out of time. So that's all the time that we can have with Jee Toon and the team. So we hope this event has been as enlightening and insightful for you as it has been for us. Our sincerest thanks to Mr. Jee Toon, Chief Investment Officer of Asia Pacific Equities at RHB Asset Management Singapore, for sharing his expertise and also invaluable insights with us today. And also we would like to also thank Mr. Joseph Chai from RHB Research for his sharing. A big thank you to all the participants. So it's essential to stay informed and adapt to the ever-evolving investment landscape. So we encourage you to continue learning and exploring opportunities with RHB Investment Bank, and to log into RHB Morning Kappa at 8 daily for all the latest information and news. So till the next session, have a good week ahead, and we'll see you soon. Thank you.
Thank you, everyone. Take care.